Welcome to episode 8 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal private equity. I'm Will Smith, here with the other Minds Capital GPs, Nicholas James and Max Lummis. The interview you're about to hear is with Jory Caulkins of Enduring Companies. Before we get to it, let's hear some of our own reactions to the conversation. Max, what were some of your reactions to this interview with Jory?
So Jory talks a lot about trust, which we've talked about and which everybody knows is one of the pillars of business. You have to build a trusting relationship with your partners and your advisors and other folks that you work with on deals and in business. So Jory was big on trust. And of course, that's a big part of who he is and who Enduring is. But one thing that kind of jumped out for me was in talking about trust, he gave a specific example. And this is an example that we at LCS, the accounting firm, we see this a lot, particularly with newer independent sponsors and even searchers that are going through a deal the first time. And it's the concept of the working capital peg. And Jory gave the example where they closed a deal with a seller and the seller was rolling equity into the deal. So a situation where the seller is your partner going forward and trust in the relationship is paramount. Well, the seller didn't understand the working capital peg, which is very common. It happens all the time. It's a very confusing concept and a confusing negotiation that happens after you've already closed the deal. So the long and the short of it is that the seller owed Jory's group Enduring, a relatively significant amount of money in what's called the working capital true-up after the closing. And rather than, split hairs and try to get fully reimbursed for the difference, Jory split the difference 50-50 with the seller. What's that worth? I mean, who knows? He didn't say exactly how much he was owed, but however much he was owed probably paled in comparison to that go-forward relationship with the seller. And the seller was genuinely confused, according to Jory, and I believe that because we see that all the time. So it's an act of good faith. We see it a lot, and it's something that I highly recommend to sponsors, particularly newer sponsors who are trying to build up their reputation and might have a go-forward relationship with the seller.
Yeah, I thought that was a great story, and I think he told it, Nicholas, because you were pressing him a little bit on. We had been talking about trust and the importance of building it, which everyone agrees with, but it's like how exactly, and give us a concrete example. And that was quite an example to actually leave money on the table in the interest of building trust. Nicholas, what did you think about our conversation with Jory?
Well, I think just to build on what you guys were talking about first, yielding in a negotiation always is helpful in building goodwill. But I think specifically how it builds trust here is that the papers are already signed and written. So Jory had the rights on his side. This is now post-closing. The verbiage is there, it's signed. And so he builds trust by saying, okay, you know what? I'm not going to be a stickler about these signed documents. I'm going to split the difference here 50-50 because I clearly see it was a misunderstanding. You signed something without having full crystal clear vision of what it meant. And that's why he debited trust into his trust bank account, as he calls it, with his relationship. As far as what stood out to me, Jory talked about his deal funnel. And so he talked about in 2024, they had reviewed 1,400 deals. They had looked at several hundred of these in detail. They had submitted 6 offers and they had signed 2 LOIs. So he calls this a very steep funnel, which I agree with. And then he goes into talking about their criteria. And surprisingly, his criteria were quite simple. There are only 3 of them. He said the first one we look at is moat. Does this business have defensibility, right? The second one is longevity. And part of Enduring Companies and their concept is that they are long-term holdco owners, not trying necessarily to flip in 5 years. So he has to ensure that the target companies are durable for the long term. And then the third criteria that I wanted to double click on a little bit is what he calls asymmetry. So moat, longevity, and asymmetry. When I hear the word asymmetry, I typically think about some kind of specialized sponsor who is really good at creating value in a particular industry or niche. And so they have an asymmetric capability to add value. However, in this case, he was talking more about the asymmetry between downside and upside. So he said the most important thing for him is that the downside is covered and protected. There is, he's baked in a 4x or 5x valuation. So based on that, if it's an all cash deal, you're getting 20-25% cash yield on that. And if that's something he can believe in, that's in and of itself a great investment outcome. But then he talks about something I thought was interesting, because at Minds Capital, we look at upside, but we don't necessarily quantify it. It's more, qualitative in how we assess upside. But he says he looks for a handful of catalysts that can materialize in 2 to 5 years, and where each of them can contribute a 10 to 50% lift in cash flow. And he says none of them may materialize, and then you're stuck with the downside scenario, as he said, with 20% yield. But if one or more of them materializes, you then see significant increases to your cash flow with the business. And so that's how he underwrites, is to look into what are the possible catalysts there and how credible are they and do I believe in them? And I thought it was just a really methodical way to approach underwriting.
It's such a good call out, Nicholas. And I feel like we just had a real world example of where something like that could have been useful. We were just on a call with a prospective investment, and he had a few growth levers he could pull, a few, as he called them, moonshots. And as we double clicked on those, it was like the moonshots were completely different in terms of their likelihood of coming to pass. One was truly kind of a moonshot, like it could be an amazing outcome, but far less likely. The other, far more likely. But when you get into those conversations with sponsors about how they envision, where they envision taking their business, it often gets very qualitative and very vague. And so I love this framework that allows Jory, maybe we can adopt something like it and allow you to really layer on top of some of these growth ideas, some quantitative analysis and some sort of probability testing. I just want to circle back on the trust, as the listener will hear. We spent a good chunk of the beginning of the interview on this point of trust. There were just two other things that I liked in Jory's approach. First of all, he mentions the say-do ratio, which couldn't be simpler, but it's basically the percentage of things that you do that you say you're going to do. And of course, it's basically his first pillar of trust is delivering on what you say you'll do. And so again, he's taking something that we all think about and kind of throw around qualitatively, and he's applying rigor to it. So there's a ratio of things that he said he's going to do and then actually delivered on. Of course, we all would like to hit 100%. Few of us do. So anyway, the say-do ratio is something that stayed with me. I think is a great framework. The other thing is I loved this kind of nuance to trust and goodwill building, where we talk about how the perception of trust is and goodwill is as important as the real thing. So if you've done something to generate those things, and the person on the other side of the table, the party on the other side of the table, doesn't notice, it almost you don't get to count it. So there's this subtlety where you want to be doing all this stuff to build goodwill with your counterparty, but also to be getting credit for it. So how do you kind of insert, I'm doing you a solid here, other person. So just want to make sure it's recognized. I thought that was such an interesting point of kind of negotiation and relationship building that's applicable not only in sponsor land, but really in all things, in all relationships. So that was a fun one. Okay, please enjoy episode 8 of the Minds Capital podcast with Jory Caulkins of Enduring Companies. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Jory Caulkins of Dallas, Texas, views himself as a collector of great businesses. A Stanford GSB grad, he honed his skills at places like Morgan Stanley and Bain Capital. He continued by starting and selling two businesses. The first maybe wasn't such a huge outcome, other than making his parents proud. But the second had a more meaningful outcome and really led to where he is today, which is the founder of Enduring, an independent sponsor that with a permanent hold strategy. Jory, welcome to Meeting of the Minds. Why don't we kick off the conversation with just a quick overview of what the Enduring profile looks like, the portfolio looks like today?
Sure. Well, glad to be with you guys, and thank you for letting me join. We currently own 4 businesses. We've bought about one a year. We've been around for 4 or 5 years now. The first 2 of those, we are decent sized minority equity, along with a few other good sized minority equity investors who in aggregate make up the controlling investor group. And then the second 2 of those, we, meaning Enduring, are the majority of the equity in those businesses. Those 4 businesses, 2 are niche manufacturing businesses and 2 are services businesses. And we've usually bought them in the range of kind of $1 to $5 million of cash flow. And then they've, since then grown at different rates. And so they're somewhat different sizes now. But those are the businesses, and it's been fun so far and always looking for more.
Great. And so about a business a year. So you started this we're in 2025, 2020, 2021 timeframe?
Roughly. Yep.
Okay. We'll maybe get a little of the history a little bit later, whether or not this was a COVID pivot in your career or what. But we'll get back to that. First thing I want to ask about, Jory, that came up a lot in our pre-call is about the role of trust in the seat that you sit in, and how you build it deliberately. So start us off, please, with giving us a kind of a picture there.
Sure. Yeah. I mean, I think the most important currency that no one talks about, especially in buying and stewarding and operating businesses, is trust, which I think is kind of foundational to all relationships, and everything that happens in business is related to people. And trust is really probably the most important currency to getting things done with people and in those relationships. So I think a lot about building trust. There's a concept I use or think about and try to talk about in our businesses that I describe as like the trust bank account, where you're trying to make deposits in that account every day, every week, as you're interacting with people, whether that's people in the operating businesses, whether it is investment partners, whether it is a potential seller of a business to you. You're inevitably going to need to cash checks against that trust bank account. You're going to need to ask someone to do something hard, or something's going to come up in diligence, and you're going to need to take kind of a negative hit to that balance. And so the more you can, in my mind, build up that trust bank account ahead of having to have those kind of debits against it, the better position you're going to be in to be able to facilitate what you're trying to do and trying to build. I don't know if that makes sense or not, but I think a lot about kind of that interpersonal trust balance, and trying to make sure I and we as an organization are continuously making deposits in those accounts so that we can cash checks against it when we need to.
I think most business people would agree that trust is important. What I want to press you on is those deposits into the trust bank account that you make. Can you be more concrete about exactly what they are? How do you proactively and intentionally build trust?
Yeah, it's a great question. For whatever reason, I've found that one of the areas where I have some capability is in doing it kind of naturally, and I've tried to distill that down a little bit, because it's probably not all about me. It's probably about things that I do naturally, and I've tried to codify that to make it helpful and useful to other people. I think some of the key areas I've thought about are probably fall into a few different categories. One is just delivering consistently. So there's a concept I like called the say-do ratio, that you want to have close to 100. Are you doing what you're saying you're going to do? The closer you can get to consistently delivering on that, then the more someone in the future is going to trust you when you say you're going to do something.
Do you start at 0 with everyone you meet? Or is there a way to pre-build trust?
I think there's ways to pre-build trust. I think there's always, trust is always a two-way street. So I'll start with that. And some people sitting on the other side of the table, or who you're interacting with, have inherently higher or lower innate trust with another person. So like, I personally extend trust very easily and readily, meaning my trust in someone else. Obviously sometimes that's come back to burn me. But my kind of default is to trust someone else until they kind of prove me wrong. And so I think there's always some level, and it varies by person, of what that person, what the going in level of trust is with that person has in you, if that makes sense. And then once you make kind of a personal connection with that person, you can kind of continuously make sure you're delivering and building that trust in some of these ways that I'm talking about, and happy to talk more about. And then pre that kind of personal connection, there's probably ways to build trust that we've been experimenting with at Enduring that are helpful too. So are there ways to more systematically allow people to know who you are or who your organization is before they actually meet you in person? And so some ways that we've done that either intentionally or some have just been coincidental has been having a fairly just open and transparent presence online about who we are, what we're doing, the good, the bad, the ugly.
Is that social media posts, Jory? Or
it's not social media. I'm pretty awful at social media, but it's a pretty detailed description of who we are on our website, what we believe in terms of mission, values, culture. Some pretty detailed kind of annual letters where we're saying what's working, what's not, and just being naked and open and transparent about that. There's a community we've been building just in service to business builders that has a podcast associated with it. And so I've often had people say, hey, we listened to this and feel like we got to know you through that. So I think there are ways I kind of think about it in terms of like pre-one-on-one personal relationship with an individual. There's ways before that to kind of build and scale trust. And I think there's more and more ways to do that through some of these kind of digital online formats. And then there's post kind of one-on-one individual connection where you can build trust and kind of continuously earn trust. And that's where you can get a much larger divergence in terms of how quickly you can build trust based on kind of tactically what you're doing. Although I hate to talk about it in tactics, it's not, in my mind, it's not like you're trying to trick someone into trusting you. It's like You're really trying to earn that trust, if that makes sense.
But when you talk about a website, annual letter, podcast, a lot of people would categorize that as marketing and visibility. So what would the difference be between visibility and trust?
Yeah, I think it's a great question. It's probably trust. I would say trust building visibility is probably a subset of broader visibility. Maybe if I'm trying to think of how to like categorize it. what we're trying to put out is authentic, not hype, like here's the good, the bad, and the ugly, and just be, and almost have it as like a both transparency mechanism and a negative filter, meaning like, hey, this is us, this is what's good, what's bad, what we're struggling with, what we're about. That is, I think, both authentic, building some trust through authenticity, but then also acts as a bit of a negative filter, or negative, has the wrong connotation, but a bit of a filter to not have the wrong people kind of coming to us, if that makes sense.
What would be an example of something negative or vulnerable that you have put out there?
I put out a lot, or try to put out a decent amount. A lot of it is more interpersonally, where, we're being open and transparent about the things we've struggled with that often, will happen in a conversation on a podcast. Sometimes it happens like in our annual letters. We just put one out for 2024. And one of the things I spent a lot of time struggling with this past year, and we did as an organization, is finding new businesses to invest in. It's been really challenging. And, I, in that annual letter, was pretty naked about, hey, the easy thing for me to do is kind of rest on the laurels of, we're super disciplined, our hurdle is really high, which I hope is true. But I'd be lying if I didn't say that, not having found a business to invest in over the last 18 plus months hadn't caused a lot of introspection and trying to understand, is it a me problem? Is it an us problem? Or is it a challenging market and we just haven't done the right volume? And so there's like and trying to be open about that internal narrative and internal dialogue, because we all think those things, right? And so I'm kind of just trying to say those things. The internal dialogue in my head and that we've had internally this year has been, well, is the hurdle high, which is a good thing, and are we being really disciplined, which is probably, I think, a good thing, or is it too high, or are we saying no just to feel good about saying no, and it's really, the root is like a fear of failing, or the root is a not putting in the effort to find something good. So that, like, just trying to be naked and real about the internal emotional struggle of thinking through that issue and trying to do it in an open forum, because we all have those things. And if you don't, then tell me whatever you're eating every morning, because I want to eat that. But just being open and real about it, I've found, one, is kind of cathartic. Like it feels good for me to get it out there and be open and naked with people about it. And then two, I think, is trust building. I've had a number of folks reach out and say, hey, I even just from that letter, and in prior letters, saying, hey, I really appreciate you sharing this. I've struggled with this too. Thank you for not sugarcoating everything, and not giving the like Instagram highlight reel of everything that's going right. And it just, like, I in prior chapters in my life, I've felt like I've needed to, if I was raising venture money or selling a product we hadn't built yet, I always felt like I needed to almost like wear a mask and be overly salesy. And one of the big learnings I had about myself in that process was I'm just not comfortable doing that. And as a result, I'm not good at doing that. And so I'd rather be much more open and real and almost overshare the negative, to make sure I'm in the right emotional spot and kind of trust building spot to operate from my best capability.
It makes a lot of sense, Jory, and I love the approach, and I feel like I'm on your end of the spectrum personality wise, spiritually, in terms of kind of transparency. But part of the reason in life we're not, as particularly business, we're not as transparent is because we will be bitten for vulnerability. So if you're pitching LPs and you talk about all these dumb mistakes you made, I don't know that you made dumb mistakes, but for example, there could be a penalty to that. You mentioned that sometimes maybe you overshare. So how do you discover the line of what is the right amount? Because I doubt even you probably has a line of where that you that you don't share, where you don't share. Maybe not.
I try to be a fairly open book and aspire to that, although I'm sure there's things that I'm sure you're right.
Let me re-ask: have you had LPs or prospective LPs where you feel like they didn't invest because because they glommed on to some mistake that you volunteered that you'd made?
I think as an example, when I'm underwriting a business, I lean way on the side of, or I try to lean way on the side of conservatism, meaning here's all the ways it could go wrong. Here's the mitigants to that. Here's the things with the unknown unknowns. And, depending on who the LP is and what their setup is, that might scare some of them because what they're hearing from other folks is often not as raw or as negative, as conservative as that. I've been fortunate in that a number of the folks that we work with, as partners in these businesses from a capital perspective, they've seen a lot of the movies. They know stuff can go wrong, and so they, I think, appreciate the fact that I'm trying to be as open and conservative as possible. The other kind of advantage I have is, we're investing a good amount of personal capital in each of these businesses. And so, they know I'm looking for all the grenades as best I can and all the, Easter eggs. And I think that's trust building too. And that's some of my, I think, makeup is just looking for how things can go wrong, making sure there's upside, but really protecting some of the downside. And then the last thing I'd say is, I would much rather be in the position where I'm transparent as down the fairway as I can about the opportunity, because I'm putting a good amount of personal capital in and representing that. I'd much rather have that and almost lean too negative and conservative and, have something not happen than over-represent something just to get a deal done, because I'm really uncomfortable in that position and don't want to put myself in that position. And I think have been fortunate historically to be able to lean more conservative and not, have to get that first deal across the line, or not have to get that first capital together, or not have to have that, first win on the board. So I don't know if that answers your question or not, but there's definitely costs. I think to come full circle on your question, there's definitely costs to being open and naked. For me personally, my emotional makeup, I know that the cost is much higher if I'm like wearing a mask or whatever, or dressing something up, and down the road, having to deal with almost like the emotional baggage that comes with that. I'd rather much more take that pain and risk up front, and remove that, off the table in the future. Does that make sense?
Yeah, actually, an experience I have, and it's still something I struggle to be vulnerable with, but I had a deal that went south. I led the deal. It didn't go well. And in the aftermath of that, it's been, and it continues to be, a question of when should I disclose it versus not. But my experience has been that if I don't disclose it and people find out, about it, especially in the early years, it's been a while now, but in the early years, if people found out about it in roundabout ways, that would really hurt me. And then they didn't want to proceed. However, if I disclosed it directly to them, not only did it eliminate that downside of them walking away, but in every single case, I found that it built trust and they wanted to work with me even more. And in fact, they were more likely to recommend me to others after that as well.
Yeah.
So I've had a very positive experience with sharing. And I think it's cultural too, frankly. America is a land of second chances. And people are willing to, hear that you have learned and hear that you have gone through something. And I find it to be a really forward-looking culture that I very much appreciate.
Yeah, I think this maybe depends on the space you're playing in or the type of investing you're doing or the type of relationships you're trying to build. But I don't know. I think at least in this space, the capital providers and investors are big boys or girls or women. They're grown-ups. They know that there's risk. They know not every deal goes the right way. Good returns are important. I think the harder thing to find is someone that they trust, and what they'd love is someone that they both trust and think that on average over, call it 3, 5, whatever the normal portfolio of deals is going to do better than average in terms of returns. Anyone can take a business and dress it up and make it look good, or a lot of people can do that and then sell it. But that is, in my mind, some pretty short-term thinking. Because Nicholas, to your point, you only get maybe 1 or 2 at-bats at that, or you need to be really good at selling to be able to bundle that stuff up and sell it a bunch of times. For me, at least, it's not emotionally worth the cost on the back end of that. I think that the harder to find thing from a capital provider space in this area, but probably many areas, is someone that they can trust. And to your point, Nicholas, it's hard to tell people when things go wrong, but I view it as a trust building opportunity where everyone's going to, pound the drum when things go great, probably. Where one has the opportunity to differentiate is when in the inevitable moment when something goes wrong, because nothing's perfect and they know that nothing's always perfect. If they hear that it's perfect, then they probably know they're not getting the full story.
Jory, do you feel like capital providers in this category of independent sponsorship feel like they can't trust a lot of sponsors they see come through the door?
I don't know. That's a great question. It's a pretty rapidly evolving and growing space. I think there is appropriate kind of diligence and skepticism that they have. And that's not to say that it's because independent sponsors are trying to pull a fast one on anyone. I think it's more the investors are cautious of the incentive structure that's generally in place to just getting a deal done. And incentives are powerful things. Turns out Charlie Munger and Warren Buffett were right about what they were saying. One of the things that, if it's helpful, I can share just tactically how we think about trust building and some of the interactions we have.
Yeah, I would love that. I think you already discussed what you do prior to meeting someone. And so that is presumably to generate maybe conversations, but also to warm up conversations before you have them. But yeah, I would love to hear, you talked about the cash balance in your account. So how do you build up the cash balance? And is it linear? Can you keep building it? And is every dollar incrementally equally much worth? Or is it more worth in the beginning versus later?
That's a good question. I haven't thought a ton about if it's linear. My guess is it kind of probably like asymptotes. You build it up to a level, and then over time, I'm sure it is a bit of a melting ice cube, and so you need to re-upping it. But I think there's ways that you can kind of systematically do that. So post a kind of direct relationship with a person or an individual or a group of people, I've found that and I've tried to categorize this, there's kind of 4 ways in my mind to innately build that trust. One, which we talked about, is delivering. So showing that you do what you say you're going to do as much as you can. Another one is authenticity, which we just talked about a bit, and we're kind of pulling that forward to the pre-relationship space where we're trying to be as authentic as we can. But people are smart. People are correctly skeptical, and they know that no one is perfect. So if they're seeing a perfect view, then they know they're not seeing the whole picture. So why not just show the whole picture? Is kind of my view. And like, life's too short. I'm either too lazy or too tired or too old to create the story. So I'd much rather have the kind of authentic version out there. So that's kind of the second. The third area that we've thought about is fairness and demonstrating fairness, and reciprocity in that fairness. So showing that, in a relationship, it's a two-way street, and figuring out ways to demonstrate that. And then the last is, and this is somewhat similar to authenticity, but I think is actually different, is transparency. And just giving a person the view into how and what you're thinking at that moment or in that interaction, those sorts of things. Those are kind of the buckets. Maybe a useful thing is to walk through an example of each of those, if that's helpful.
Why don't you share with us the most impactful of that set of tactics there?
The most impactful, and this has been hard for me to do because I'm not like a getting credit seeker, but it's to make sure you're getting credit for when you're doing these things, you're getting credit for them in that interpersonal bank account. So an example, and I'm very bad at tooting my own horn, often to my detriment. But in something that's important like this, I've found that is valuable. And to me, it's important enough to go out of my comfort zone and make sure that it's happening. So as an example, showing fairness and reciprocity. There was a scenario in buying one of our businesses where the working capital peg was defined as something. A month or two after we closed, it became clear that the sellers, who are great people, still involved in the business, they rolled some equity. They misunderstood what that meant. We tried to walk them through it. We articulated it very clearly, but
it's a hard one.
It's a hard one to explain, and they don't, and some of that's on us, but certainly, like, legally and structurally and documentation wise, it was on them. Were we to go by the letter of all the agreements, it would just be like, hey, the answer would have been, hey, tough luck, but this is what the docs say. Where we landed was we just we said 50-50, split the difference with them. Like, here's what you thought. Here's what the documents say and what we thought. Let's be good partners to each other about this and split it down the fairway. That, in the immediate near term, had a real economic cost to it. But they're still very important to the business. There's a number of benefits to doing that. And I wouldn't feel great about, because I think they were genuinely not understanding what that was. So that's literally what happened. And then, to your question, tactically, I wanted to make sure that they knew that, and that we were kind of going above and beyond for them. Yeah. And actually, our accounting firm who was helping us, who helped us with the QOV and helped us with this process. They reached out on our behalf and just said, "Hey, just so you know, we have never seen this happen before. This is very rare. That the documents say clearly that you guys are not correct." Yep. And so in that scenario, fortunately, we were able to a totally third party, just kind of on their own behest, reached out, and we were able to get kind of credit, I would say, for that. Yep. With them. That's kind of one example. Another is literally just how you phrase things. So in terms of delivering, that first bucket, when you're handing something to someone, sending over an email of something that you said you'd get them, saying, "I committed to get you X by Y. I wanted to make good on that commitment, so here it is." It's almost just like a framing thing. Or in terms of transparency, one of our other businesses that we bought, it was a wonderful couple. They wanted to step back and retire, and they were thinking through a number of different things. And I tried to actively kind of sit on both sides of the table with them, trying to take their perspective, which you can do, and a lot of people do in a conversation. The way I just tactically frame the wording of that is saying okay, now I'm wearing, I won't use their real names, but now I'm wearing Joe and Jane's hat. I'm on your side of the table, and this is how I look at this perspective. And then I would switch back and say, okay, now I'm wearing Jory's hat or Enduring's hat. So they knew that I was actively trying to see things from their perspective and calling out things on their behalf. You're going to want an NDA in place now so that you feel comfortable and you're protected if you share more information. Just volunteering, things like that, which would happen anyway, I think help. They're small things, but they help build a lot of interpersonal trust. So there's, in my mind, kind of high return to those smaller things.
Just one more question on trust. Every independent sponsor or deal maker or higher educated person, frankly, will think that they're extremely trustworthy. And for the most part, they are. So how is this a differentiator, or how do you make it one?
I would say there's a difference between one's self-perception and what externally they're perceived as. So I think internally, you're probably right. That person defines themselves as trustworthy, and they probably are trustworthy. But there's a difference between that and what a new person in a new relationship will perceive them as. Those are two separate things, and the faster you can get those lined up, the better.
Great point, Jory, about kind of ever so delicately needing to claim credit for going out of your way to do something, out of goodwill or on behalf of the person on the other side of the table. It is delicate. Your personality is such that you don't want to take credit for things, but it's important because you don't want to be doing things, going out of your way to be doing good faith acts all the time in a transaction, and then nobody ever notices at the same time. Because then you're really not building up that balance. The balance is a perception thing. So if nobody's noticing, you're not building the balance.
Yeah, it's delicate. It's a delicate, almost EQ driven calculus, for sure.
Yeah.
But I do think it is really important to meaning trust and building that bank account is really important to a lot of the things that happen in really any business situation, but in being, an independent sponsor, operating teams, they need to charge up a hill into gunfire sometimes. And if they don't trust you, they're not going to follow you to do that. And you could be looking at a weird, wonky deal that has amazing asymmetry, but has a lot of hair on it and takes a lot of effort. And if you haven't built up that bank account, your capital partners are going to, think twice if they want to jump in the trench next to you on that. And a business seller, if they've got a bunch of people that are all telling them, to Nicholas's question, I'm trustworthy, and I come from this background, how are they going to on day one or day zero, whatever, like all those people are going to look pretty similar. So
Yeah.
it really, in my mind, is a big differentiator that is hard to do well and right, and is something that compounds over time, in one's network, in relationships, those sorts of things. So we think a lot about being long term, and in my mind, that's one of the most important kind of like accounts we can build on our balance sheet as an organization over time.
In our pre-call, we asked you, how do you evaluate new opportunities? And you brought up a Venn diagram that is structural to how you approach new situations. Could you walk us through that?
Yeah, it's really like, do we think it's a good opportunity, and do we think we're the right ones for that opportunity? And so I'm happy to talk through each of those. And the danger is in convincing oneself that the crossover of those two circles is bigger than it actually is. But I think that is the core of what we're trying to think through every time we look at a business. Is it a good business is takes a lot of work to figure that out. Is it a good business and a good opportunity? It takes a lot of work, and I'm happy to talk a little bit more systematically about how what we think is that fits that criteria from our perspective. The second is the harder emotional thing to do, is like have some introspection, think about where we're strong and weak, and say, okay, this is a good opportunity, but either we're not the best fit for it, or it's not the best fit for where we're strong.
So a lot of independent sponsors would perhaps only say, is this a good opportunity, and then pursue it, especially if it's within their industry specialization or whatnot. But you are, I think, more deliberate on the, is it a good fit for us? It's not just the industry specialization. It goes much beyond that. And so we would love to hear more about both sides of this Venn diagram for sure.
Sure. Yeah. I think just for context, a lot of it will come back to how we're set up, which is a little bit different than most. And really the two, I think, most important aspects of that are one, or maybe three aspects. One, we're long-term oriented. So we're thinking about businesses that hopefully will be around for a long time and have good moat to those businesses. So we're not thinking like, is this a good growth business that may not have moat, but one that I believe I can flip to the next seller in 3 to 5 years. We're thinking about, is this business going to be around for a very long time, and or is it a decent business that we can make into a business that could be around for a very long time? So the longevity of our perspective actually does inform our definition in a way that's a little bit different. The second area where our kind of setup probably makes us think a little bit more differently is there's a much larger amount of personal capital that we and I are putting in from our balance sheet into every one of these investments. And so kind of by design and kind of just, otherwise we're somewhat rate limited in the opportunity set that we can and should go after. And so that drives kind of the third element, where we're a bit different in that I focus a lot more on what I think will be returns and quality versus quantity. And so we've set up everything, and all that kind of falls out of longer term perspective and wanting to build wealth for myself, for our teams, through equity and participation in the businesses, not through AUM growth. Does that make sense, kind of like foundationally how we might be a little bit different than some other operations in the space?
I think so. I think you had worded it as, I care more about moats than multiples, because you're not planning to sell it. So whatever it can look like in 5 years to another buyer is not paramount to you. What it can sustain for the long term is.
Yeah.
And Jory, I'm also hearing, I'm starting to feel a little bit like Enduring is the Caulkins family office with some LPs, because I've heard you mention your own capital a couple times. Long-term hold. I guess kind of for those two reasons. Is there some element to this where it's almost like a small family office with LPs?
Yeah, I mean, we do a decent amount in each of them. We're not the largest check often, but we're a pretty good sized check in each of the businesses. I just think that's really important to me. Like, it forces emotional discipline in me.
Yeah.
If for no other reason.
Okay.
This might be weird, but I feel more emotional tax if we have an investment that isn't doing well, that's just my money or our money, Enduring's money. It's actually more taxing to me if there's other people's money in alongside it.
Sure.
And, we have less money at stake, but there's other people's money. And so I think I don't know, we'll find out, in a number of years or 300 years, depending on how quickly we compound. But I think I would always like to have partners in alongside us, because the discipline it forces me to have. And for the same reason, I would always want a significant amount of our own money in each of these as well. Nicholas, back to your question, tactically, in that first circle, like, what do we define as a good business? Or what do we look for given that foundation, like kind of somewhat differential foundation I was describing? There's the literal defining of the box. So it's like $1 to $5 million ish of cash flow. We can probably go up to 10, for the right opportunity, based in the US, those sorts of things. But really what we're looking for, our funnel's pretty steep. So in 2024, we looked at over 1,400 businesses. We narrowed that funnel pretty quickly down to, probably a few hundred that we looked at in more depth, and then 6 that we made offers on and 2 that we signed LOIs on. So our funnel is like pretty steep. What we're looking for and weeding out pretty quickly in that funnel is really based on kind of 3 criteria. And this is roughly in the order at which we're able to identify them. And so like how things fall off in the diligence and funnel process, if that makes sense. The first is, and Nicholas, you brought this up, what I call like moat for multiple. So it's basically like, what multiple are we paying for this business on earnings versus the quality of the moat that business has. So we generally pay, I think historically we've paid between 2 and 6 times for our businesses. Some of those businesses there's a lot of things that goes into the calculus, but as you get higher on the multiple front, the moat needs to be a lot stronger for that business, in my view. So I think people talk a lot about multiples, but if you're paying even a average multiple for a unmoated business, like, in my mind, that's not a great investment, especially because we're very long-term, to your point, Nicholas. So I'd be reasonably confident in paying a average multiple for a fairly unmoated business if I knew I could sell out of it, or had good probability of selling out of it in 3 to 5 years to someone else and make it their problem. But if we can't define a moat in a business, and try to put some quantitative numbers around what that is and articulate it in a sentence or two, then it's hard to find a path to doing that. And so that's usually the first fall off thing. Is I'm always looking for, does this business have existing moat to it and protection around it, or the right kind of like industry structure or setup to the industry where they can and should have moat. They just don't know it or haven't fully like dug it yet. And then secondarily, okay, if that is true, what multiple are we paying, and is that a good multiple to pay for something like that? So that's kind of area number one. Area number two is longevity. Just like, is it something that can go away in 2 or 3 years because of technology or something like that, or is it something that where we see good longevity of the industry to the macro demand behind it, that sort of thing? That's like really hard. It's all that this is also a squishy thing. Like there's as much art as science in this funnel, although we try to keep pushing it to science. But really longevity, is there good macro behind it? Is something that is going to be around for 5, 10, 20 years? At least, like, is there going to be ongoing demand? It might shift how that's manifested, but as long as we think we can be fast enough to shift with it, we look for that. And then the third is asymmetry. So are we buying at a spot where we're pretty downside protected and there's, 2 to 5 operating things we could do to really meaningfully improve the cash flow of that business in the first, 3 to 5 years. So that's a pretty steep funnel. A lot of those things are, we have tried to articulate those as best we can and put numbers around those as best we can during diligence. But some of that is also just experiential based evaluation of trying to assess it and going really deep on the diligence side of things when we get serious about something.
Oh, this is great. And what we do at Minds Capital is somewhat analogous, but maybe not as structured in step number 3. So we talk a lot about, okay, first we need to review downside protection. And that for us is an extensive checklist, 80, 90, 100 points. We cover markets, target, sponsor, deal terms. And that's really going through the factors that could take the business out in some form or fashion at some point in the future. And then once we've cleared that hurdle, we say, okay, is there enough upside potential here to believe in? Do we see a pathway to a 4 or 5 times outcome for this investment? And that's how we go about it. But you're structuring that last step in saying, are there specifically 2 to 5 levers that you can pull that can drive the upside? Can you explain a little bit more about what you mean by that?
Sure. So just as context, we think a lot about cash flow back to our equity. So like if we put $100 in each year, how many dollars do we think we're going to get distributed back to like the holding entity and or to our partners in that business? When we're underwriting to make it apples to apples for some capital partners, we have to do, a 5-year, if we sell it at this multiple, what multiple of invested capital do we get? But really, a multiple of invested capital and a terminal multiple is just a shorthand for cash yield back to equity and the net present value of that stream of cash. And so we think a lot about, it's basically really what matters is 2 things: cash flow back to equity and what the trajectory of that number looks like. So is it flat into perpetuity? Is it going up slowly? Do we think it can go up quickly? Do we think it's going to be a slow melting ice cube, downwards? Or do we think it's going to drop off in like year 2? In which case, we're probably not going to be doing that deal. But so we think a lot about cash flow back to equity. When I say to your question, Nicholas, when I talk about operating levers in a business, I mean, is there something that we think we either have experience changing or we think will be reasonably achievable to change within the first couple years? We don't want to do it we rarely do it on day one because we know there's a lot we don't know about the business. But, are there a handful of things that we think we could improve that could increase that cash flow to equity yield by anywhere from 10 to 50% over that first few years? So if we're going in and thinking our target is a cash flow yield each year of 10 to 30%. If we can, if there are ways we think we can increase that in the first few years, if there's 3 different things that we can do that we think might each, if we hit it out of the park, increase it by 10 to 20%, and a few of those hit, then we're in a really good spot. Obviously that doesn't always work out, but the more kind of arrows we have in the quiver and ways to win, the better.
Right, because a lot of sponsors will say, my base case is a continuation of what has happened. The company has grown at 12% per year. That's what we're expecting going forward as well. And there are often a lot of ideas about what they're going to do, but it's not necessarily structured down to what you call a catalyst. So you're saying, yes, we expect it to continue more or less as before, but here are also a handful of catalysts or arrows in the quiver, as you say, that can really change the trajectory to the upside of what we're doing. And I imagine also protect against downside about any scruff that may happen along the way. If 1 or 2 of them hit, that gives you further protection, right?
Yeah, in our underwriting, I generally think probabilistically about a bunch of different scenarios. So I usually try to think like, what is the unimaginable awful case? And then, that is, and like really push the stress test of that. And usually that's, I'll weight that anywhere from 5 to 25%. And then there is a more realistic downside case, which I think would be a standard to aggressive downside case for a normal sponsor. And that's usually, I don't know, it depends, but anywhere from 10 to 25% for that. And then there is usually kind of our target case, which is generally, we try to be pretty realistic. So it's usually like flat to down a bit from wherever we're buying in. And then there's the upside case, which is, layering in a few of those different things that we think are doable and can provide real, it's almost like option value if those hit. And so we're kind of, in some ways, this is not fully the right way to think about it, but we're trying to buy good cash yielding assets with embedded optionality that isn't fully priced in, where maybe we are differentially capable of extracting that upside option value based on operating history or other businesses we've been involved in, or some sort of insight on the business that, in the lower part of the market, someone else hasn't thought through.
Jory, to wrap up, I want to ask about the long-term, the permanent hold approach. And so that's obviously an enormous decision to make at the outset of enduring. What did that decision look like for you?
After selling that second business that I had started, I'll call it 5 years ago or so now, I spent probably 3 to 9 months really thinking through what I wanted to do next.
Mm-hmm.
To me, and this might be an ego-driven thing, I don't know, or pride-driven thing, or all the negative things that could be fueling it, and I'm always skeptical of that. But I wanted to build something that was bigger than me and would last hopefully longer than me. For a number of reasons, but I kind of just viewed it as like hopefully something where I could, it would be like my life's work type of thing. I also take, so that's been one driver of the longevity. Another has been, I feel real deep meaning and purpose in when someone is trusting me with something. Back to trust, like I guess that's, I mean, I didn't even mean to bring that concept up, but like clearly it's important to me. But like when a business owner is sitting across the table and we're talking about something that he or she has built up for his whole life, or in many cases, something that's been built up over multiple generations. To me, it feels much more natural to shake that person's hand and say, yeah, I'm going to do the best I can with this, with what you're trusting me. If I have a long-term, we have a long-term view on that, because if I'm going to sell it in 3 to 5 years, I can do my best to vet that next owner, but I can't, it's really hard for me to make that commitment because I have no idea what's going to come next down the road. And so in terms of making good on that commitment to that business seller, that longer perspective, I think, is important. Same with, in different ways, the people in our companies, and the leaders of our companies, and our capital partners. And then I'd say the last kind of tactical piece for the long-term view is it's really hard to find good companies. It's really hard to find good, in my view, investments. Maybe, again, to our conversation on this year's annual letter, maybe that's due to a fear of failure in me, or maybe that's due to a lack of effort on my or our part. But it's really hard, in my view, to find good opportunities. And so when we find them, I really want to keep them and keep building them and push behind them and do the best we can with them. And often that takes a long time to do well. And I think the returns to doing that well compound over time, hopefully, if we've bought the right businesses and are doing the right things to them. But it all sounds great when I say it. I'll let you. Maybe we should do another episode in 20 years, and we'll see how it's going.
Why do you think more independent sponsors don't have a permanent or a long-term strategy? Because everything you said certainly makes sense, but it's still the vast minority of sponsors, or private equity in general, that does a long-term vehicle. Maybe another way of asking is, what are the cons?
The cons are, it requires a lot of patience and a lot of discipline. And not to say that others are not. What I mean by that is, financially, we could sell our businesses today for a lot more, and that would mean a lot more dollars to me immediately today, probably. And incentives are real, and people are in all sorts of different financial, setups, life setups. A lot of people have kids' schools to pay for, mortgages to pay. There are all sorts of very legitimate reasons why the selling something good and pulling forward a lot of that value makes sense for them.
Mm-hmm. Mm-hmm.
I think I've tried to. One, I think I'm somewhat fortunate in that having some financial and balance sheet kind of downside protection and runway to have a long-term perspective. That's a real thing. And a lot of work has gone into making sure that's there and enabling the longer-term perspective. And then I've tried to stay really disciplined around what we're spending to enable that long-term view. So what we're spending at the holdco level, but then literally also just personally, what we're spending as well. Because all that, in my mind, all of that SG&A kind of burn at the organization level or at the personal level, you're kind of trading that off versus, in my mind, long-term value. And everyone has a different spot on where they fall on that curve. And for some people, and for a lot of people, the right answer is, to pull forward that value. And so it's maybe just a difference of perspective, or a difference of what people are trying to solve for. I come at it from certainly a spot of, the financial goals for me and us and for people in the businesses. And we want to, knock on wood, shoot the lights out in terms of returns and what we're doing for people. But I also, and I think we more broadly in terms of the leadership at our companies, approach it from a kind of a purposeful perspective as well, in terms of being a steward of people's businesses and jobs and livelihoods and other people's money. Our approach is that being more long-term minded helps us in doing that as well.
Well, Jory, thank you for coming on Meeting of the Minds to share a little bit about Enduring and your approaches to everything. Of course, the trust building here is for me at least the biggest takeaway from this conversation. So thank you for that. If people want to get in touch with you, how do you prefer they do that?
Sure. The easiest way is just shoot me a note. My email is jcaulkins, so JCAULKINS @enduring, ENDURING.co. Or you can visit Enduring's website, which is enduring.co.
Fantastic. Jory Caulkins, thank you again for coming on Meeting of the Minds. Really appreciate your time.
Enjoyed it. Thank you guys for having me.
Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.